How do you ease mortgage pain amid rapidly rising interest rates? Today, we're going to go through exactly that. We're going to look at how you can optimize your mortgage, how you can renegotiate with your lender, and as well as looking at some alternative options. So let's dive in, starting off on the top. So let's see what's actually going on. Well, as we know, there's a lot of action happening with interest rates at the moment. They're rapidly rising and set to continue to increase. So there's calls for borrowers to take action and cut costs on their mortgage, particularly with raising rates and alarming levels of interest rates. So households are actually facing supersized consecutive interest rates that are coming up in the ensuing months. They're actually saying the cash rate could hit 3.35% by November. If we have a look here at Westpac's forecast, which has recently been updated, the official cash rate as we speak is at 1.35%. There's pretty much their prediction saying that the cash rate officially will get up to 3.35 by March next year. And interesting to see that by 2024, they're predicting that things will start to reverse course. A lot of experts are saying there's going to be a rate rise next month in August of 0.5%, another one in September. So we can potentially see another 1% in the very short term, with rates slowly going upwards to that 3.35% sometime between now and late this year or early next year. What this actually means for borrowers is if you've got a modest mortgage, even if it's only $500,000, that means if rates actually get to that 3.35%, payments are going to increase $968 per month. And those that have $1 million mortgage, well, that means another $1,938 per month out of what is already a very tight household budget with cost of living increases, a number of different factors, fuel being quite expensive. Now mortgages on top of that. Some of the other big four banks are predicting the cash rate might only get to the 2.6% in November. As we said here, Westpac sort of saying by November, December, they're thinking 3.1. In any case, they're all sort of predicting rates are definitely going to go up. Now, financial expert Stephen Mackenbecker has said that starting to cut costs out of your monthly budget is the priority, and you should start looking at preparing for things like high repayments, and start with a little bit of research and look at doing a bit of paperwork. So with rising rates, it should be a priority to look at lower cost home loan options and put that on the shopping list. So especially as rates are set to go up another 1.25%. Already we've seen in the last 3 months, 1.25% increase. And as we talked about earlier, 0.5% increase in August is expected, with another 0.5% coming up in September. So let's look at some practical tips on how you can get through this. One thing is, what we are seeing is some of the borrowings that are happening with the banks will start to potentially get tougher and tougher. We're seeing a little bit of new data from APRA talking about the bank's exposure to what they call risky loans. So when there's a debt to income ratio above 6 times, they're saying in the December quarter of late last year, 24.4% of new mortgages written had a debt to income ratio of 6 times. To be honest, that debt to income ratio wasn't really policed at the end of last year. So I can see why that was quite high. We really found at the start of this year, a lot of the banks started to tighten up the screws and become more aware of this. And I guess this data shows that, there was a significant increase as such. The regulator came in last year. September's quarter had a 23.8% debt to income ratio above 6. So what we're going to find is it might even be that the banks tighten the screws a little bit more to make it that much more of a challenge to secure funding, because APRA considers a debt to income ratio above 6 as a risky loan. We still have many lenders that are absolutely fine with debt to income ratios above 6, but we are finding some of the smaller lenders are really cracking down on that. Now, what does that mean if you were to look at a debt to income ratio with medium house prices above 6? Well, in Sydney, you need a household income of $188,000 or over to avoid being classed as a risky loan. Now, a lot of cases, that's a fairly high household income. And that's where we're going to see that with the prices still elevated, these debt to income ratios might still follow suit. Now, We did also find that ABS had data recently talking about last year as recording the biggest annual rise on record. So there was a 23.7% increase across the nation in terms of property prices. And no doubt, that was all over the news. We've seen that recently with prices and how quickly they've gone up. Now, let's talk about some solutions here. If you are struggling with mortgage stress amid rapidly rising interest rates, let's talk about some practical solutions. Now, first is optimizing your offset account. Now, I don't necessarily agree with just an offset account. You can do the same thing with a redraw. I'll explain the differences in a minute, but the main thing is put your savings to better use. So if you do have, for example, $10,000 sitting around in a different account, in a savings account, earning you very little interest, what you can do with that money is use it to either offset or put against your loan. So effectively, then you're not paying the bank, let's say if you're on a 3.6% interest rate, you're not paying them that, you're saving that, which effectively means you shave $400 off each year on your interest bill that you'd otherwise pay the bank. So I think that's perfect in terms of being able to reduce costs. If you had 50 grand, well, that's going to be 2 grand a year. Now, I just want to touch on the differences between offset and redraw and show you that they're pretty much the same thing. So in this example here, we've got a loan of $500,000. Now, in an offset environment, this is where effectively you've got an offset account, which is still transactional, but the major difference is there's a linkage. So the offset is linked to the mortgage. So any money you have in the offset account will automatically reduce the interest that you'd otherwise charge. So instead of the bank calculating interest on $500,000 each day and charging it monthly, what they do in this example is go, the loan less what's inside the offset account, well, we're only going to charge you interest on $490,000. If you kept that in there for the 12 months, well, then that's where you save the $400 per year in interest. The more you have in the offset account, the more interest you save. So that's where putting money against the loan can make more sense rather than putting it in a savings account where you might only be getting 1% interest and paying tax on that because you've earned interest. Putting it in an offset account, you can save not paying the bank that 3.69% in interest. Now, in this very same example where you have redraw, these two do the exact same thing. The major difference with redraw is, as we can see here, there's no linkage. So what you have to do is you have to actually transfer your $10,000 that's in your transactional account, park that in the home loan. So you park the $10,000 in the home loan account. Effectively, the bank would calculate that you've made an overpayment. So interest is only charged on $490. And then you still have access to it because it's a prepayment that you've made additionally on top of the minimum repayments. So same, you're still getting charged on $490, but effectively you can take that back out when you need it and then transaction from there. Both do the same thing, slightly different in terms of the way you arrange things. Typically with an offset account, there are annual fees and charges. With a redraw, you can set up very basic, no monthly fees, usually lower rates. So they're ways that you can further optimize your cash that you have sitting in your account to better reduce interest. Option number 2 is switch to a no-frills loan. So we talked about the fact that a lot of times if you have an offset account, you'd be paying an annual fee. Usually that's $395. You pay a higher interest rate. And you've got all the bells and whistles, you get a credit card, all that sort of stuff. But there's inherent extra costs associated where if you switch to a redraw, effectively you can get the same look and feel with the lower costs. Now, just keep in mind, if you are fixed in, a lot of times you can't have an offset account. A lot of times there isn't redraw. So this is more specific to variable loan options. But I guess, yeah, we'd encourage those looking out there to review their existing rate. If you're paying anywhere from high 3s or anywhere in the 4s, there's definitely avenues where you can refinance, get a cashback incentive, and switch to a cheaper costs. So I think it's definitely worthwhile to look at switching to a cheaper cost option. So now, I guess based on some data that CanStar has, they suggested that an interest rate cut, so reducing your loan by about 1.36%, you'd shave about $400 per month off your mortgage. So there is definitely a lot of costs you can save there. So between optimizing your cash, reviewing your loan to get a better rate, there's money to be sort of saved in doing so. Now, another option is negotiate your mortgage with your existing lender like you're a new customer. So a lot of times what we do find is the banks give new customers better rates than existing customers. So it's pretty important to have a chat with your lender, try and negotiate to see if you can get a better deal. Some other things you can do is even fill in a discharge request and pretty much tell the bank you're leaving. So it's a form. It's pretty easy to find if you want to look it up. Look up your bank and then discharge, fill it in, sign it, send it to the bank, and let them know you're leaving, and see if they come back to you with their on their knees and say that, don't leave us, we'll give you a good deal. So what we do find is, based on CanStar's data, they're saying that most existing borrowers are paying 0.46% higher compared to new lenders or new borrowings for the same customer. So that means you're out of pocket by $123 per month in additional mortgage repayments, or 44 grand more over the life of the loan. So it definitely pays to try and negotiate with your lender there. That's something we can also help with. So if you've got a mortgage and you're wanting to have a chat and find out if there is anything your existing lender can do, hit us up, and we're definitely happy to have a chat. One thing to keep in mind is also think about steering clear from interest only. Now, whilst it may feel like you're paying less in terms of your monthly repayments, it actually means you pay more over the life of the loan. And you'd also find that there will be repayment shock once the interest only ends. So what does that actually mean? Well, let's look at a mortgage repayment calculator. And let's say you've got a $600,000 mortgage. Let's say you've got a really good deal. You're paying 3% interest only. Well, 3% interest only, you're only paying $1,500 per month in loan repayments, which is an absolute steal. But you've got to remember, a lot of times your mortgage starts off on 30 years. It's 5 years interest only. So once your interest only period ends, you'll be on a 25-year loan term, and there will be a massive repayment shock. You go from $1,500 per month to $2,845 in terms of the monthly repayments. But not to mention, you pay a lot more interest when you're paying interest only. So what we always recommend, look to set up as principal and interest. At least you get used to the repayments. You're slowly paying down the loan and chipping away at it. And it means that you're not going to be up for any repayment shock or any nasty surprises once the interest only period ends. Now, in circumstances where you're struggling, you're finding that you can't really make ends meet, well, that's where it's definitely advisable not to bury your head in the sand. Have a chat with your lender. There are options out there. So if you're finding that your bills and your loan repayments are exceeding your income, well, you need to talk to your bank and talk about financial hardship and seeing if you can come to an agreement or an arrangement whereby you can negotiate with your bank and have an agreement to defer or reduce your repayments, restructure your loan, or even change to interest only. Now, I know we said don't do interest only just earlier, but this is more where you're in a real pickle and you need to get out of it in potentially a little bit of time. And we saw this over COVID, where there are a number of people in certain industries, pilots, hospitality, that were out of work. They made these arrangements and they're able to keep their home. So definitely wise to talk with your lender. Keep communication open, because if you keep quiet, bury your head in the sand, that's when the bank can get a little bit cranky and knock on your door. There's avenues out there. There's a national debt hotline. You can call the number here, 1-800-007-007, where they can help. We're here at Hunter Galloway are mortgage brokers. So if you are having issues with your mortgage, you want to see if you can reduce costs, you want to have a chat about renegotiating with your existing lender, or looking at setting up an offset or understanding Redraw a bit more, hit us up at huntergalloway.com.au. We're based in Brisbane. We're mortgage brokers. There's zero cost for our service. We deal with people Australia-wide. So if you're in Perth, Adelaide, Sydney, Melbourne, we definitely can help. Looking to refinance, looking at releasing equity to do some renovations, or even buy an investment or an owner-occupied property, call us on 1300-088-065 or visit us at huntergalloway.com.au, and we'll see you next time.